Hi, I'm Mary Lyons, the Wealth Woman.
And I'm Eric Alexander with Acorn Grove.
Welcome to the Wealth and Income Podcast.
So today we have a cool topic around sort of the investment side of the world. And so one of the things that Mary and I talk about a lot is this idea that mindset beats strategy and strategy beats tools. And so one of the things we wanted to talk about today is this idea of investment strategy and how to really build out diverse portfolios, not just on the asset side, but on the strategy side, on the what we would call the style side. And so we're going to walk through a couple of the details there, and we might delve a little bit into the tools to make those happen, but I really wanted to focus on the different strategies that can be deployed in an investment portfolio.
So, if I say that in a slightly different way,
Please.
this is going to be a focus on investment strategy, which is how can we make sure that the investments are heading in the right direction, and make sure is maybe the wrong way to phrase that if we're talking about investments, because frequently in the world of investments, you have very limited options to create guarantees.
Right.
But we're going to be focused in this particular episode on investment strategy, specifically for the investments that are tied to the stock market. So in our world, we call those securities. So we are not talking about real estate. We are not talking about private equity. We're talking about what you can do with your 401k, your Roth IRA, your brokerage account, those types of investments.
Yeah, and this conversation was born out of some frustrations that we had years and years and years ago. And one of the things that we kept seeing is you have periods in the market when it's kind of up and to the right, and it's kind of nice, and it's a 2013 kind of market, or a 2023 was kind of a nice market, right? Where the market is generally going up and to the right. There's not a lot of drama. It's a very sort of stable, up moving market. And then you have markets which are down. You have 2001s and 2008s and those kind of markets. And then you have this sort of weird 2011, 2007, 2022, where the market is just all over the place. It's some days it's up, some days it's down. It's very choppy and uncertain. And when we started looking through the landscape of how we were managing money, one of the things we kept seeing were, okay, we're going to solve this problem. We're going to solve the up and to the right problem. How do we go manage money? And then the market shifts on itself, and it's like, wow, all of those things that we just put in place are underperforming, or they're not doing exactly what we'd like for them to do. Let's switch strategies to see if we can get a better rate of return or better performance or lower risk in this particular market. And we wanted to change horses a little bit.
Yeah, I think that this is something that probably a lot of people sitting in our roles think about, in that how do you drive performance through changing markets when you don't have predictability? Right. And I think for us, a lot of this conversation was really rooted in, too, that there are times when you can see that if you're building a diversified portfolio, and you're using modern portfolio theory, you're looking at really allocating across different asset classes, that there are times when it is abundantly clear that a particular asset class is going to create additional risk and the potential for additional loss, rather than actually helping contribute to upside. And so if you know that, it is very hard to feel good about making a recommendation that somebody diversify into that asset class in that particular environment. And I think there is probably nothing more top of mind than the bond portion of a portfolio for a lot of our listeners right now. Because if you put money into a bond portfolio and interest rates go up, the value of the bond goes down, right? And so if I can just use this as a concrete example so that it's easier to get the application when you go into the strategy, if I pay $100 for a bond and it's paying 5%, that means that my yield on that bond is $5 a year. So I know there's going to be a check for $5 every year from that bond as long as I hold it to maturity. But if the interest rate environment changes, and now for $100, I can buy a bond paying 10%. So I'm getting $10 for the 100 that I have invested in the bond. I want that. right? And so if I try
Yeah.
and sell my $100 bond that's only paying 5%, no one's going to pay $100 for it, because if they bought one of the new ones, they could get $10 a year for the
Right.
same investment. So why would you choose to earn half? And so if you look at what people would be willing to pay for my existing bond at a $5 yield, they're only going to pay $50 for that if they're looking for a 10% rate of return.
Right.
So what I've done then is that if I sell that so I can get liquid and then move into a different tool, is I'm going to lose half of my principal. And so in a rising interest rate environment, that's the risk. Now, the flip side of that is if I have a bond that's paying $10 and I paid the $100 for it and interest rates go down to that 5%, then people are going to pay more for my bond. So what you do in a rising interest rate environment and what you might do in a decreasing interest rate environment are two totally separate things. But when you think about traditional portfolio allocation, it's, you know, you got some percentage in stocks, some percentage in bonds, some percentage in commodities, but putting money into the bond portion of a portfolio when you know it's going to be worth less because the Fed has signaled additional interest rate increases is a really, really hard sell, I think. Not just to the consumer, but internally, like to myself as an advisor. It's like, why would I want to do that? And so finding ways to get safety and also find upside potential. Sometimes those two things are at odds. And if something that is traditionally considered safe is actually dangerous from a loss perspective, what do you do?
Right. Well, and the other component of this is the stupid humans in the mix. And the stupid humans being us, by and large, but also the client, right? In modern portfolio theory, it is we're going to set this thing up and we're just going to ride the ride. Well, that's really great when the ride is up. Everyone is return tolerant. That's really hard to do when the market's going down, right? Because it's hard when you're in the middle of a 2008, 2009 cycle and the market's dropping. It's like, come on, Mr. Smith, you can do that. Let's just hold on. It'll be okay. And he's like, well, hey, I'm retiring next year. Right. Or I'm retiring in 5 years. I can't wait. And so the idea that just hold on makes perfect sense in the long run, but not everyone has a long run in front of them.
Correct.
When you're 20, suck it up, baby. You're going to make it. You're going to be fine. You got 45 years to go before this is a problem, right? You can recover from this. When you're 64, it's a whole different conversation. And as someone once told me, this actually told me about a month ago, he says, if you're not apologizing for a portion of your portfolio every quarter, you're probably not diversified enough. Like you're trying to spread the risk, but it's a very hard conversation to have where, look, we're producing this thing, just like what you said. And we know that some portion of it is going to suck.
Right.
And we're not sure because I can't predict the future. And so what kind of came out of these conversations that Mary and I were having over and over and over and over again was, how do we do it better so that we're not predicting the market? We're not trying to outguess it. We're not trying to time it. We're just trying to set up the solution so that we can win in hopefully more environments than not, right? And so sort of the scope and the style diversity came out of that. And it was strategic, tactical, contractual was our dumb marketing name for that. And it was an attempt to have a blend of not just assets, but a blend of styles.
So I think that's key, what you just said, Eric. Not just a blend of assets, but a blend of styles. So I like to go back to the idea of diversification because this comes up a lot, right? Advisors talk conceptually about how diversification is a really good thing on the investment side. But when you say things like, oh, you should diversify and add permanent insurance, all of a sudden they don't like diversification anymore. And I think when you look at kind of the purpose of diversification, if diversification is good, then we need to look at how many ways we can diversify so that there are different approaches, right? And so that can be the type of assets you're holding, but that's really only the first layer. So the managers and their investment approach is another layer. Whether you
Right.
have contractual guarantees or everything at risk is another layer, right? It even goes into, that if you're saying, should I have insurance? Should I have investments? Should I have real estate? That's the asset type. But the style aspect of how you're approaching that could be different. So if you're in real estate, it could be, I'm buying this property because it's speculative. I'm buying this property, it's commercial. I'm buying this property, it's residential. There's this
Flipping
is
versus renting, right?
yeah, there's a bunch of different ways to diversify, or maybe you're buying mortgage-backed securities and you're still in that real estate type space. But I think that again goes to asset types. What about approach? And this is where strategy, I think, starts to come in.
Yeah.
And I think that the way you look at this, Eric, I'm always so intrigued by this because I'm like, ooh, we're doing something, it's good. And you're like, but wait, what if we did this? And it adds in. So talk a little bit about some of that tactical approach to investment style.
Yeah, and so the tactical part of it has been, I think, a little bit of a stepchild in the industry for a while.
Mhm.
But the tactical piece, I think, in its proper proportion, and we'll talk about that in a minute, can be really powerful. And what tactical does is it's basically responsive design. And so you have managers, you have different ways to go approach it. But the basic end of it is you have managers that are sort of looking out a little bit ahead, 6 months ahead, 9 months ahead, as best they can, as no one can predict the future, but they're trying to sort of reposition the portfolio and change the mix internally with what they're managing between stocks, bonds, and commodities, maybe even real estate on some of them, to change the mix a little bit to be better positioned for either a big run up. Hey, all the economic indicators are going positive. We're seeing a bunch of green lights all across the board. Hey, let's move out of a defensive posture and into an offensive posture. So in the vernacular, it would be let's sell a bunch of bonds and buy a bunch of equities as a concept, right? So let's see if we can capture it all. Or as they see some of the economic indicators sort of slowing down and interest rates are going up, and so the market's going to pull back a little bit. And some of those other moments, they'll pull back on the equity allocation and maybe do more defensive postures, maybe dividend paying stocks instead of growth equities,
Something like that.
cash, real estate, bonds, depending on what the defensive piece is. But it's that idea that they're not married to, we're going to buy the S&P 500 and we're going to go to Mars for 30 years and hope it works out. They're in there sort of mucking about, right? And that there's some value in the mucking.
Yeah, and I think there's kind of two approaches to this. So it's not saying we can predict what the market's going to do. I want to be
100%.
really clear about that. But it is interpreting what's the Fed doing, what's happening politically, how is the geopolitical environment impacting what's happening, and then responding to the data.
Correct.
And it's also a matter of looking at trends and responding to the trends. So it's not predictive, but it's taking the information in that we do have, and then if a pivot is needed, pivoting. Right. And it's not saying abandon your strategy. We're now doing something completely different. It's more along the lines of how do we just shift a little bit?
Yeah. And a great example of that might be looking at price to earnings ratios in the market. If you're getting really, really high, meaning the prices and most of the equities are over what the value of the stock should be. And there's some like a bubble forming. Like we saw that in the late 90s where, hey, I've got an idea for a .com, and nobody even asked what the idea was. They're like, you just said .com, here's $1 billion, go do it, right? And so when you see those kind of environments, if you're being rational about it, it might be an opportunity to pull back a little bit from the gas and from the exuberance, knowing that you don't know when the bubble might break, but it might be prudent to pull a little bit of your winnings off the table and go do that, right? So that's that idea of being a little bit responsive, not predictive.
Yeah.
Because if we were predictive and really good at it, we would own a mountain somewhere and we wouldn't be doing this today.
A giant mountain island.
We would.
You can have mountain. I'm taking an island.
Just do it.
Yeah, I mean, I think this is key too, right? Because it goes into, we don't always know what's coming, but we have to try to position ourselves for opportunity while at the same time managing for security. And I think if you just park your flag and say, I'm just holding this and I'm not ever making any changes, then there you go. Because even when you think about the traditional strategic model, you're buying assets,
Right.
but you still look at reallocating based on what's actually happened. So there is an element of tactical management, even in a traditional buy and hold strategy,
Correct.
because if one portion of your portfolio gets out of whack because it does really well and the other doesn't, then you're still repositioning in response to this. So this is just taking that same idea to the next level. And I think
Correct.
that's kind of the whole gist of it, but it's an approach that I think matters because if you have an advisor that talks to you once a year and you're just doing strategic management and the environment changes or the Fed signals a different policy, there has to be a response to that that's real time
Right.
or you miss it.
Well, and I think that goes to that other overlay that we've been talking about quite a bit recently is there is a chemistry equation, if you will, specifically between strategic and tactical, right? How much of the portfolio do we want buy and hold? Because buy and hold has been working for a long time.
Right.
Um,
To be clear, we're not saying throw that out.
oh my gosh, no. And by and large, in most of the portfolios we look at, like having a slightly heavier concentration onto buy and hold makes a ton of sense because they're lower fees typically, they're in the market, so whatever the market gets, you're going to get, and you'd have this sort of sleeve on the side that is more responsive.
Mhm.
And the conversation we've been having a lot is that chemistry equation, that push and pull between strategic and tactical is kind of a hard one to get right because as the market goes more up, you want to tilt more strategic. If the market is going down and crashing, you want more responsive. And so being able to kind of tweak that ratio over time and even within the year is really critical because the market keeps adjusting.
Mhm.
And especially, we're recording this podcast mid-July of 24. I have no idea what happens in the next 3 or 4 or 5 months.
Oh, for
Uh,
sure.
but traditionally normal election years have a tendency to be slightly chaotic. And so like, how do we adjust that along the way, knowing that there's precedent for having chaotic markets. And so how do we adjust some of that and
And
keeping our finger on it without it being heavy?
yeah, I think that if you kind of put some words around this, it's the difference between being rigid. This is the allocation model. We don't
Correct.
deviate from that. The environment is what it is. Here we go. And being flexible, which says, hey, the environment's changing. We need to be nimble and we need to adapt to the new environment without abandoning all the things that we know to be true and correct. So it's sort of the next level, I think, of application. But I
Correct.
think the questions that I would ask if I was a consumer and I'm talking to my advisor is I would say, how responsive is my portfolio? Do I have built in to the strategy, like I got to talk to you every month because that's how we determine what changes we make? Are you just leaving it alone for 12 to 18 months? Or is there an element of money management happening where you're making changes to the portfolio? Or if
Right.
it's not you making the changes, is the mutual fund, the ETF, the underlying investment strategy, is there wiggle room within that to make changes when the market is changing? And those are
Yeah.
questions that if you're thinking about right now and you're like, well, I have no idea what the answer is to that, or you know conclusively that the answer is no to those
Right.
questions, then it's time to have a conversation with your advisor or a new advisor about how those concepts could apply to your portfolio.
Yeah. So where can they find you to have some of those questions, Mary?
If you are looking for me, you can find me just about anywhere you use social media at The Wealth Woman. What about you, Eric?
Yeah. And I'm at Economics with Eric, wherever you use social media. Thanks.
Specific financial concepts and advanced strategies are presented to you for educational purposes only. We cannot and do not guarantee their applicability to your individual circumstance. We encourage you to seek personalized advice from qualified professionals on all financial matters.
Provided content is for overview and is not intended and should not be relied upon as individualized tax, legal, fiduciary, or investment advice. Neither Wealth Woman, Acorn Grove, or the Wealth and Income podcast, nor their representatives provide tax or legal advice. For answers to specific questions and before making any decision, please consult a qualified attorney or tax advisors.
All numeric examples and any individual shown are hypothetical and were used for explanatory purposes only. Actual results may vary.
Investing involves risk, which includes potential loss of principal. Past performance is not a guarantee of future results. Guarantees are subject to the claims paying ability of the issuing insurance company.
Life insurance should be purchased by individuals that have a need to provide a death benefit to protect others with insurable interests in their lives against financial loss. Life insurance is not a retirement plan, investment, or savings account.
Not affiliated with or endorsed by the Social Security Administration, the Centers for Medicare and Medicaid Services, or any governmental agency. Insurance and investment products, not a deposit, not FDIC or NCUA insured, not insured by any federal government agency, not guaranteed by any bank or credit union, may lose value.
Please visit the Wealth Woman website disclosure page for other important disclosures.